Our next speaker is one of the most knowledgeable people on monetary reform, and I think in a way the most modest. And that shouldn't be, but he is. That is Joe Bongiovanni. And Joe runs something called the Kettle Pond Institute. But he is truly a monetary reformer since he's a second generation monetary reformer. His father led the way and taught him, I think, methodology, taught him what to look at, and Joe can tell us more about that. Joe has done more study on a particular part of our monetary panel, I think I have to say, than anybody else, and perhaps he'll talk about that today. But please welcome Joe Bongiovanni.
I want to thank Stephen not just for the introduction, but for the opportunity to be here to speak with you all. It's a privilege that I thoroughly enjoy. I come here every year to learn. I come here every year to have a little chat with people about things that are going on. And I want to thank Stephen for the opportunity to do that. And at the same time, for all the work that he has done on behalf of political, economic, social justice, because that's what this is really all about to me. Like Stephen said, my dad was a monetary reformer. How could my dad, he was a Christian capitalist businessman, the only way you could really define him, pretty much in that order. How did he end up being a monetary reformer? I couldn't figure it out. It was in the 1960s, and he was telling me about how money was the most important thing, and I was saying, it's not really. It's peace, it's the environment, it's, keeping the ecology going. Dad, money don't really matter about anything. All those arguments that we're hearing from Howard. So I was giving them to my dad, and he just kept saying, well, sorry, but, you're going to be able to do those things after you get the leverage over there to change the world. And this is the leverage to change the world. And it took me a long time to become convinced of it, that he finally, said to me, you got to read Dr. Frederick Soddy's books on money and his papers on money and other things. And if that doesn't convince you, to provide you with an understanding that you need in order to try to do all the things that you might think that you want to do. And I was like, well, sorry, Dad, I'm going to move up to Canada, and I bought some land, and I'm going to be just growing my own vegetables and raising my own food, and I'll see you later. So, and that was the truth. And that's what really happened. I felt really bad about it years later, but I did move up there. And then finally, the dad said to me, well, look, I'm going to come up and visit you. You read that book by Soddy, and if you read that book by Soddy and tell me why you're going to be able to do the things you want to do, and then if you can do it, when he come up there, I just said, you know what? You're right. You know what? You're right. We do have to do this money thing. And so I started studying it. I started studying it with him, and so I really thank him. I mean, on a daily basis when I'm out there doing what I do, quite frankly, and what I do is sort of defend the scrimmage line. That's how I look at my work. I get onto a blog every day, or 2 or 3 or 5 or 10, and find out who the smartest people in the room are that think that they understand the monetary system, and I engage them. That's what I do. I engage them. I'm not argumentative. Stephen's sometimes critical of me. He says, you're too polite, And sorry, I went to Catholic school, and we learned to say please and thank you, and I still do. So anyway, that's just kind of by way of background. But I want you to know that, first of all, I thoroughly enjoy what I get to do, and that is to discuss what money is and the history of money. And I thank Stephen for his, for his book and for his work of spreading the word, because quite frankly, until I became aware of Stephen's work, it was a really lonely world out there. I signed up in 2006 on Huffington Post when it came out as a greenback revolutionist. And still there, I still am. But right about that time was when I started to find out about Stephen's work, and it was in 2009 when I came here. I think to the first conference I came was in 2009, and I've been coming back every year since because I want to be part of this, and this is the next thing, okay? This is the next thing. We're hearing about it today from people all over the place that confirms and acknowledges the fact that this is the next thing, and it is going to happen, and we're going to be part of it. At least I'm hoping that I'm going to be able to be part of it. So, okay, let's see. I've got to figure out how to get rid of that. Sorry, I'm not that adept here. Minimize it, she said. I said, okay. So, yeah, so by the way, if you looked at the program, it says the title of my talk is The Central Bankers Need Our Help, which was subtitled, Their System is Broken and We Know How to Fix It. But that was my talk from last year. Oh, hey, I know what to do with this, Jamie. I know what to do with this, I think. Let's just see if it works. Let's take it down there and park it, okay? And that way it can stay on all at once, and I don't have to look at it. So anyway, sorry to get back to say that, no, really my talk is titled Money the Next Thing. So obviously there was some mixed communication, not mixed, negligence, laziness, not sending Stephen the title and the outline of my talk. Stephen worked up an agenda, and my talk from last year was still on there. So for those of you who were here last year, might have remembered my talk. I'm going to go into a little bit. I'm actually going to start where I talked from last year, because it was about the central bankers, and the central bankers kind of acknowledging it. So I'm going to talk, hopefully, for 15 minutes about central bankers, central bank venues, that kind of stuff, and then I'm going to slide, if you will, into a chat about modern monetary theory. And why modern monetary theory? Well, this is to go back to 3 years ago, I think it was, that Jamie and I, Greg and maybe a couple of others were sitting up here on a panel, and we decided we wanted to talk about the difference between modern monetary theory and what we do with monetary reform. And an esteemed, right, it was Steve Walsh, exactly. So it was, an esteemed, distinguished professor of economics who was present in the room and got up and stopped us from having that conversation, because he wanted to assure us that the people at Modern Monetary Theory were our kindred spirits, that in fact they really loved us, but they just didn't quite understand it. What we should be doing is, trying to make peace with them, somehow on their terms come to understand what it is that they're talking about. And by that time I had already been prevented from commenting at Naked Capitalism and later on at New Economics Perspective and stuff, and I still am. I still am. I still try to get on there. I still try to sneak on there using a different nom de plume, trying my sister's IP address, trying a bunch of things, but they know who I am. And they do not let me go on there because they do not want to engage in the discussion of monetary reform. Now, they just call it the debt-free money crowd. They call us the debt-free money crowd, but they just do not want to have to engage the idea, and it's to their detriment. And I will tell you that I have, numerous email communications between myself and Susan Weber, who's Eve Smith, who owns Naked Capitalism, and always reminds me when she kicks me off again, I own this thing, and I'll be like, I don't want it, I just want to be able to talk to people, Thought that's what you were trying to do here. And their subtitle of the Naked Capitalist, fearless commentary on money, economics, finance, and politics. And so political economy is really the way that I approach the whole discussion of monetary reform. The whole discussion of money is about political economy, the political economy. And that's why what Howard has just laid out is so tremendous, Howard. It's so tremendous, because that is political economy right there. Political economy is sort of something that's been forgotten as a field of study. Not that there aren't people getting political science and different types of degrees, but really of political economy, to me, political economy is what it's all about. So there, I've just wasted my first 15 minutes, and I haven't talked anything yet about what I wanted to get started with. So I'm going to try, and again, with that bit of an outline and background in mind. Well, that didn't work. Let's see. Try that again. Let me try the other one. Hang on, Jamie. Nope. That's what I said. We tried the arrow. Come on, Arrow. Oh, is it because I got that autoplay thing is still on there? Okay, all right, okay. Oh, let's see if we can try that. Try it. Okay, so for the. Oh, thanks, Jamie. So last year, I started out, and in fact, my whole talk last year, if you recall, was a discussion around the interview that Dr. William White did at the Cobden Center, which is a libertarian Austrian, economics group in the UK, whose site I'm on all the time, and who don't mind me coming on there and talking about monetary reform and all that kind of stuff, and engage me. Well, although I shouldn't say that universally, because there are a few people on there who call me names, and tell me I shouldn't really be on there. But for the most part, they do engage. But this was Dr. William White, who was the former director of monetary and economic affairs at the Bank for International Settlements, which was really kind of like the peak of the peak. It's the central banker, central bank. And, monetary and economic affairs is the whole shtick over there. And he was the director of it. So there's hardly a more knowledgeable person, in my opinion, in the world than Dr. William White. And fortunately, along with his knowledge is a great deal of candor. And Dr. White, in his interview, said things about what was going on with the central bankers of the world. And what did I say that they were? What did I say that it was that they were going on about? Okay, now, let me see. Okay, good. Hopefully I can read that up there. So this was a couple of his observations. They're starting to ask whether they have somehow been backed into a place where they don't really want to be. Now this goes to the, anybody, I happened to go back to my hotel room, turn on the news, CNBC, 3 times while I was there for 15 minutes. They said monetary policy is not working. That's how they say it. Monetary policy is not working. We need to do fiscal policy. And that's actually a meme and a theme that's going wide out there, but nobody really wants to say how you join monetary policy and fiscal policy in a way that serves, our needs. So he said, they're backed into a place where they don't want to be. And he said, I'm working on a piece for the G30, the group of 30, the vocal group of 30, another prestigious organization, which basically deals with the future of central banking and the future of monetary policy. I sense from talking to many of the members, many of whom are previous central bankers, that they're very concerned about the direction this has taken, in particular, the continued over-reliance on stimulative monetary policy. Well, what is that saying? That's saying that monetary policy cannot stimulate the economy the way it's set up. And how is it set up? It's set up to add more debt. Try to have a debt-saturated, debt-overhung national economy and try to add more debt to it to get it fixed. And he says, it's not going to work. There's an over-reliance. We have to do something else. But how else can we add the thing that we want to have in the economy, which is additional demand? And the answer is purchasing power, which is, to me, the number one quality of money. So he said, an increasingly large number of central bankers are actually looking at what is going on and saying, we're being asked to do something that is effectively impossible. Okay, so why am I, I'm repeating this because it's what the central bankers are saying, and what the central bankers are finding is that something else has to happen. Something else besides this debt-based money system that we all know is the theft of prosperity for the people that concentrates all of the prosperity and the wealth at the very top, because the money issuers are the top of the top of the top of the top of that very unstable structure. The beanstalk that Howard put up there. So they're saying that they're being asked to do something that's effectively impossible. To their credit, they recognize it. Really, to their credit, they recognize it, because they might not have recognized it. Now here he had been talking about the situation with the European Union, and the fact that the European Central Bank had decided to try to do QE, something that was totally illogical. He said, why would these guys try to do QE? He says, it's mad here, it's mad everywhere. It's more of what got us into this trouble in the first place. More of the same, what got us into this trouble in the first place. Now that was Dr. White's observation. In a nutshell, most central bankers know that our economies do not face a liquidity problem, but a solvency problem linked to excessive debt accumulation. I want to try to let that sink in. We don't face a liquidity problem. We face an insolvency problem. There's not enough money to pay the debt. And if you can't pay the debt, you can't keep adding debt. Who was it that had the slide up there? I really forget who it was that had the slide up there. That said, if the payments exceed the new money creation, the jig is up. And if you understand money, that is the nature of the equation. Okay? I'm sorry, it was John Howell. I'm pretty sure I remember that now. And so that's his way of saying it. It's a solvency. You're not just broke and broken. You're insolvent. You know, the national economy is insolvent when the national money system fails to function properly. And all the national money systems right now fail to function properly. If there's a solvency problem, central banks can't fix it. Period. Period. You know, why isn't there I think maybe at this stage last year, Stephen, I said, why isn't there a National Monetary Commission trying to answer that question? And then Stephen told me the answer to that. The only way that this can be fixed is by inflation, which with the debt levels being the way they are, could very quickly get out of hand. Now, to me, that's central banker speak, quickly, okay? That's central banker speak, because they talk about inflation like as if it was a good thing, you know? But when they talk about inflation, I think they talk about expansion, but they use the term inflation. And inflation is merely a markup in general prices. And we don't really need a markup in general prices. What we need is more money to create more demand, to have more prosperity. And the last thing he said, I think increasingly they are discomforted more than anything else. I think it's not just the ex-central bankers, but increasingly the people that are still holding the levers. The monetary policy lever holders are finding that the system don't work. They're starting to ask whether they have somehow been backed into a place where they really don't want to be. So the reason that I'm saying that is because there has to be a next thing. There will be a next thing, and it's not. You know, they can't look in the rearview mirror and figure out the way to go forward. And they're coming to that conclusion. So what are they going to do? Well, they're going to try something. And hopefully, if they try some of the things that are going on that we've been talking about in this room, we're going to find that one of the things they're going to talk about might not be our version of the facts. Okay? They might try to finesse and wiggle their way into another situation. And so that brings me to Lord Adair Turner. He's a guy who, when he wrote Debt, Money, and Mephistopheles, something about the debt, the level of debt concentration, the global debt concentration, and he said something, he said, maybe the final subtitle was, and how to fix it. Okay, and how to fix it. And to me, I'm a total how to fix it guy. I don't really care to talk about the problem too much. Let's just say enough words to make sure we understand the problem, and let's talk about how to fix it. So Lord Adair Turner, and he wrote that paper. Now that paper was a year or two old, but then he come out with this book, Between Debt and the Devil. Money, Credit, and Fixing Global Finance. Well, there it is again, fixing it, So I was fortunate enough to get that book under the Christmas tree, and I read through it, and my wife, she'd been tolerating all my monetary reform gibberish for about 45 years, and when I tell her, no, I really need to read that book because this guy is kind of like leading the dialogue, and I read the book, and she saw, as I was reading the book and as I was coming to the end of it, that I wasn't really smiling, I wasn't really so happy about it. She goes, what's the matter? I said, he don't really get it. I said, he really doesn't get it. And so I was like, I'm really disappointed. He says that he knows what Fisher and Friedman were talking about with 100% money, and Henry Simons, he pulls all these names out of there, and they're totally about replacing totally 100%, the debt-based money system with a system of producing national equity, basically. And yet, his solution when he comes to the end of it is this. Well, if we come up with a gap in the GDP that is not able to be achieved by private investment, meaning private borrowing, then the government should step in and do a modicum, not too much, because it's dangerous, because it's from the devil, of what he calls overt money finance, which what we would call public money administration. So his fix is too limited, too late, and in fact, upside down. So the funny thing was, I thought Michael Como was going to be here, but when I got finished reading the book, and I was really so frustrated, I sent Michael an email. I said, Michael, I just read Dear Turner's book, and I thought he was, somebody who got it, but to me, I said, I'm really disappointed. What's the matter with this guy? And he wrote back and said some very kind words about it. Dare Turner said he's the most open-minded of the technocrats out there, so you sort of got to, move him along with baby steps, and I hope you're not going to criticize him, something like that. But I mean, my respect for Michael is tremendous. So I basically wrote back to him and said, I'm not sure what I'm going to do, but it ain't going to be nothing. And so this is the first article that I wrote. Oh no, that's the second article that I wrote. Maybe I missed it. Okay, all right, I didn't miss it. So this is the first article that I wrote, and it was published in the Global Economic Intersection, and it's called "That's Not the Devil, That's Real Money." And you can get the gist of what I was saying, because the stuff that you're afraid of, the stuff that you're telling us, that nobody should go anywhere near because they might get irradiated or something like that, if not chemically driven to the where the devil lives, is all wrong. It's just all wrong. Either you understand what Fisher was saying with 100% money, and the papers are in the back of the room. Either you do get it or you don't, and you don't. And so that's the gist of my article, of this article. And like I said, I defend the line of scrimmage. So I had been writing with Dr. William White on his paper and on his interview, and I had been writing I wrote a letter to the Lord Adair Turner. And I said, here's the link. This is going to be published next week. I just wanted you to see it, and I wanted you to understand where I'm coming from. I'm a monetary reformer. You don't get it, even though you say you get it, and people think you get it, but you don't get it because I explained to them what Stevens Arlanga says. We need a public money system. We don't need to rely on that stuff in a minuscule way. And when I got finished with that, I really thought I was only half done, so I did a further considerations on Lord Monetary Finance proposal, in which I don't know if you can get the gist of the cartoon there, but I said, he's trying to Frankenstein it. He's trying to take a half of the public money system and half of the private money system and make something that's going to work and live together, okay? And so I wrote, number one, that ain't going to work at all anyway. But if it was going to work, it has to be first the public money system. And then if the public money system doesn't deliver something, then let the private money system fill it in. But really what we need to do is a 100% money system. And why wouldn't it work? If you don't have a good reason why it wouldn't work, then it should be what overt money finance is all about. So that was that was the dialogue that was involved with his book. I did send him a copy of this article before it went in. It had a different title. It actually had Frankenstein in the title. And the guy who runs Global Economic Intersection asked me if I could just bring it down one notch, and so I did. And he put that in there. And this was the third article that I wrote, and this is in keeping with our theme here, which is the problem with money and banking. Inseparability. Okay? Now, that might seem either logical or corny, but the fact is that they've been running Perry Merling. I don't know if you guys know who Dr. Perry Merling is. You know, he's kind of an infamous guy who deals with money, the Treasury, and articles. And so he wrote all these money and banking papers: Money and Banking 1, Money and Banking 2, Money and Banking 5, Money and Banking 8. And then he was upstaged by a couple of modern monetary theory economists who started writing their own money and banking, because they all think they know about money and banking, how it works, and it's all about the accounting, by the way. It's all about the accounting. So there was a 17-part money and banking series that was on global economic intersection. And so I called up John Lounsbury, who runs it, and I said, I'm doing an article on money and banking. What's it about? I said, inseparability, that's the problem. You know, if you can't get money without the banks issuing it, and if we can't, and the banks can't issue it because with secular stagnation, negative interest rates, however you want to think about it, what's causing us to do that, then we have a problem. And we want to solve that problem. It was what Irving Fisher said. One word, a one-word fix: separation. Separation of money from banking. That's what we want. So I wrote that article, and it was highly criticized. And then I did one on the $39 trillion VIG. Now, first of all, the word VIG needs an explanation, unless you're a poker player or a loan shark. If you're a loan shark, you know what the VIG is, okay? That's because you loan and what the VIG is what you get back. So it's you gain, okay? So I said the $39 trillion VIG. How do I get to $39 trillion? And let me tell you something. In the course of writing it, I realized it's at least double that, okay? The VIG is what we've lost, okay? The VIG is the public equity that we have failed to gain. That's what it is, okay? It's the VIG is the public equity that became private profit that led to those people getting up to the top of the beanstalk. That's how they got there, with our money system, with our commons. They used our commons to get there. And I say, let's quantify it, let's quantify it. So, $39 trillion VIG. Well, we got a $19 trillion debt, and half, at least when I wrote that, that's what it was. I honestly don't know what it is today. But $19.5 trillion doubled. Why doubled? Why doubled? And the answer is accounting, okay? Because if we got a negative $19.5 trillion because of the loan sharks being in charge of the money system, and we did exactly the same stuff, and we financed it by debt-free money, we would have $19.5 trillion on the asset side of our national accounts balance sheet. So we would be $19.5 trillion plus versus $19.5 trillion minus, and the difference is $39 trillion. However, that's only the principal. Okay, and that's why I say I know it's double that amount, because there's been compounding interest on every dollar that we've borrowed, really since we've been a nation, and fell down on the constitutional protections that we're supposed to have. So I wrote that article, and I'm really only raising my articles because I want to try to present the dialogue that's going on, out there, that's, I think, important for us all to hold. That is to say, like Howard, he's doing that great work, at the Greens, because he's going to confront progressives, leftists, even radicals, who want to do something really good for the planet because we need to, but they don't understand money. One of the things that my dad told me, Karl Marx did not understand the money system. He said, I'm sorry, but he thought he was making a revolution, but he left the bankers in charge, and look where it got us. Because they can manipulate the whole thing. Okay, so that's that part of it. And then this is kind of like one of those memes that I was talking about earlier. Helicopter money. Everybody knows what helicopter money is. The picture comes immediately to mind. There it goes, here comes the money, and everybody's got some. But when you talk about helicopter money today, we talk something about, kind of central bank issued helicopter money. And to me, if you don't have a public central bank, and I mean a real public central bank. I don't mean one that says we own the stock in the corporation. I mean one that works for us, like the NEAT Act empowers for we the people. And so helicopter money is in the air. But why? It's a concept. Really, what is it? It's a concept of debt-free money. It's a concept. To me, it's a concept of debt-free money. When Milton Friedman first spoke about it, he spoke about it in terms of helicopters dropping dollars from the sky, and that fell on everybody. And how much debt was created? None. So how big a helicopter do you want? That's why I said, look at it. How big is the helicopter? How big is the drop? Well, I say, whose helicopter is it, and whose money are they dropping? That's the important thing going forward, because this meme of helicopter money is going to be very, very widely discussed in this near future. I can promise you that. And as it is, we have to speak up and demand that we get out of it what we want, which is the public money part. So, okay, so I'm going to move on now. This is still sticking, believe it or not, with the central banker theme, because this is the announcement of the 25th annual Hyman Minsky Conference put on by the Levy Economics Institute at Bard College this year, which I'm fortunate enough to attend. I don't know why they let me attend, but they do, And I go there every year, and I try to ask relevant questions, pertinent questions about whatever it is that they're talking about, to try to get and by the way, I have great conversations there. Honestly, I have great conversations there. Sit down at lunch with central bankers or people from the Fed or Treasury or whomever, and I find the people are always engaging when they're at lunch. So even at the refreshment break. So this was this year's conference, and I want just putting it up there because I'm going to mention some dialogue that happened over there, and I want everybody to be able to go there and see it, because it's all available there. Okay, so that's their announcement of it, and there's a number of panels, and this was the panel that I was most interested in. Minsky, Inequality and Monetary Fiscal Policy Outlook. Boy, covers a lot of stuff. You got inequality, you got monetary policy outlook. So the speakers are, on the left is Dr. Scott Fulwiler, and in the middle, Dr. Stephanie Kelton, and on the right is Dr. Jan Kregel, 3 doctors, who are all, by the way, nice people and bright people. Very nice people and very bright people. Okay, but I swear they do not get money. And Dr. Kelton is the chair of the economics department at the University of Missouri, Kansas City, which is the hub of modern monetary theory activity. So the main thing about Dr. Kelton and why she kind of rose to huge fame is she's a post-Keynesian, basically, and then a modern monetary theory person on top. And I have no problem with post-Keynesianism, just so you know. I'm totally post-Keynesian type of person. Dr. Scott Fulwiler just moved into the University of Missouri, Kansas City Economics Department just with this semester. With this semester. And he took Dr. Randy Ray's place, because Dr. Randy Ray moved over to Bard College, which is where Levy Economics Institute is housed. And so anyway, they gave this talk, and I want to try to, if I can, to parlay a part of Dr. Kelton's presentation, because she was there speaking as the former chief economist to the Senate Finance Committee. And she had been hired by Bernie Sanders, one of my favorites in the world, and even still. Bernie brought her in because she's a post-Keynesian. She can talk about the fact that why we need to do deficit spending when the private investment is not making the economy achieve its potential. And she's really great at that, and she does that really well. So she presented on her experience at Senate Finance. And what was her experience? Well, basically, she said we can't do anything. And there's one reason why. Public debt. She said, both sides of the aisle abhor any discussion of an increase in the public debt to achieve any social good, to achieve any benefit especially to the public. So they say, if you're going to do anything, what you really have to do is, the PAYGO. I don't know if you guys are familiar with PAYGO. It's a budgeting thing. If you're going to add something to the budget, you got to take something out of the budget because you ain't going to increase the debt. Okay. So her talk there was about, because of this fear of public debt, both sides of the aisle not willing to do anything, not able to do anything, and nothing is going to change. She said that, But she also brought out the fact that, I don't know if I'm going to be able to do this. She also brought out the fact that as part of her presentation, she works with the construct of functional finance. And I don't know, functional finance is actually a big part of the post-Keynesian school. Functional finance, something brought about by Dr. Abel Lerner, who was actually a very good economist and knew a lot of stuff. And what it basically says, I'm going to try to say it basically says, is that the surplus in one sector of the economy, being the private sector, is equal to a deficit in the other sector. And it sort of stands to reason in the sense that if you take the construct of what it's supposed to be doing, is to say that you have this much economy, this much of it is private, this much of it is public, this much of it is maybe current accounts with foreign trade. But anyway, those are the three components, and those things all go counterbalance each other. And if you understand that, then you can see that the economy can only grow by virtue of having one of those sectors take care of the growth. And that's why it's okay to borrow. Okay, it's okay to borrow. Borrowing is okay. Borrowing is not only okay, it is good, because the route to prosperity is through borrowing. Okay, and I will take issue with Mark Pesch on this issue of public debt. But anyway, so she said, and Lerner said, she said, Lerner was a big, a big proponent of, what we would call public benefit, government, government working for the people. So they finished their talk. Dr. Fulwiler is actually a real specialist, a really knowledgeable guy on the interactions between the Fed and Treasury. That's his specialty, the interactions between Fed and Treasury. And that's why I think, as soon as she had the opening from Randy moving, she got Dr. Fulwiler on there. So there's come a period of time at the end of their talk, and they open it up for questions, and I raise my hand, because I want to engage at the line of scrimmage, and I will tell you that sometimes they don't give me the mic. Honest, they don't. But it's not a conspiracy. I think it's just luck, maybe. But here I am sitting there. That's me. That's the back of my head right there. That's why I took that screenshot. I had already raised my hand. Jan Kriegel was looking at me like Joe Bongiovanni again. But fortunately, there was a person that had the mic. She saw me raise my hand. Kriegel didn't call on me, but she brought me the mic. So. All right, I have to change my glasses here because I'm going to try to read something from my screen. I want to tell you about the dialogue, and this is where I'm going to say it. MMT drives me crazy. Okay, MMT drives me crazy. When I really engage people about trying to understand MMT, it drives me crazy. They talk about stuff. I have something else here that I'm not going to be able to get into, which is a dialogue between myself and Warren Mosler, who's the granddaddy of modern monetary theory, the financial person behind all of this stuff. I'm not joking about that, okay? Warren Mosler has a website called Center of the Universe, where Mosler Economics, comes from. And I'm going to just take a minute to give you the background. Back in 2007 and 6 and 7, modern monetary theory was being formed. It was being formed by a discussion that was pretty much managed by Warren Mosler, okay? And Warren Mosler is a banker and fixed income security specialist who made many millions. And he lives down in St. Croix, and he sails his sailboat, and I'm not jealous, of them doing that, okay? That's perfectly all right. I got my little sailboat and I sail it on Chesapeake Bay, and I'm happy. But anyway, Warren Mosler set up all this stuff, but I watched the dialogue evolve, okay? They had an open forum exchange of ideas, and it happened over months and over years. And Warren Mosler, he finessed the discussion with something called functional equivalence. Okay? So modern monetary theory is built upon functional equivalence meme. So that's functionally equivalent to that. So it's the same thing, so why talk about it? Why bother? Let's do one or the other. And let's do the debt one. So at the end of her talk, At the end of her talk, when they handed me the mic, I said, well, I guess, you know, what it comes down to after my sort of paraphrase them is, why aren't we printing the money? You know, one of the things that Abba Lerner said is the government should print the money. Didn't Lerner say that deficit spending should be funded by printing money? Why aren't we talking about that? Why aren't we talking about that option? Yes, it would take a change in the law to do it, and we got that. But it would also satisfy both of those guys, being the Republicans and the Democrats, because we would not have to cut spending, and we would not have to raise taxes, and we would not have to issue public debt. You know, so that was my question, you know. So you got to realize there's a lot of central bankers, there's a lot of chief economists at central banks there, there's regulatory people there. You know, somebody mentioned Ed Kane earlier. Ed Kane and Walker Todd. Now, to me, the price of admission to hear these guys give their talks, tremendous stuff, just tremendous stuff. Fortunately, the price of admission is free if they let you go, which they did, you know, which they have, and I've been going for over 5 or 6 or 7 years. So to my question, Scott Fulwiler responded first, even though I was directing it at Stephanie. He said, I agree, mostly because they're the same thing. That's functional equivalence, you know, in his thing. Printing money and issuing bills is the same thing. Bills, in this case, being more public debt. It's the same thing. And I said to him, oh, that's not really true. If it was the same thing, Bernie would be supporting it. There was some chuckles. There were some chuckles, and there were some nods, and there were some people saying, you know what, that's right, you know? So they didn't want to let me get away with that. So Stephanie Kelton said, well, let me explain. What Lerner actually, this is the narrative. If you go there and you take that, you will listen to it, and this is what you will hear. Stephanie Kelton, Dr. Stephanie Kelton, Chair of Economics, University of Missouri, Kansas City. What Lerner actually explains is that he wasn't proposing the government change the way it finances its deficit. He was explaining the way in which the government already finances deficits. And what Lerner explained was that government deficits are already financed with new money creation. How many central bankers did I tell you was in the room? Because it was 150. Okay? So look, you know, she's educating me, okay? When Congress gets together and want to authorize $1 trillion in infrastructure over the next 5 years, they just count the votes. Who's with me? $1 trillion, she goes. And enough hands go up, and we've authorized the decision. And the checks will go out. We have just decided that we're going to spend $1 trillion. Keep that in mind for a second. The checks will go out, and Scott will explain why this matters, but the spending itself leads to creation of new money. Imagine. Why are we wasting our time here? The spending itself will result in the creation of new money. What are we doing? Taxes will come in, and over the course of the year, tax revenues will come in, and it isn't until the end of the year that the government even knows whether it has run a deficit or not. Senior economist at Senate Finance just made that statement. Okay? So I spend 100, I collect 90, I guess we ran a deficit. And under current law, when I engage in deficit spending, I'm required to borrow. Hello? Hello? That's my point. You know, your point is that government spends money. It creates money when it spends. Now you're saying my point. Which one is it? You know, I think they might have taken the mic back by then. But anyway, so I want to buy treasuries, she says. I spend 100, I tax 90 out, so the rest of the economy has 10, so I'm required to borrow. I say, who wants to buy treasuries? Enough people say, I'll take them. I'll get to 10, I give it to the treasury, and it's done. It's all done. All done ex post. All the complex coordination creates the illusion that what is happening is that the bonds and tax revenues are coming in and are paying for spending. Now this is where I have to say this. I thought maybe I was the only one that heard that. You know? I was like, excuse me? Ed Kane is in the room, you know? Walker Todd's in the room, and people like them, people who know this stuff like the back of their hand, like nobody's business. And I just sat there and went, I did send them an email that night, I will tell you that, and I brought this up, and I said, you guys said this, and you said that, and that ain't true, and what are you doing? You know, why are you carrying on this charade about what's going on here? You know, the law says we have to borrow the money, you know, period. That's what it says. And it says the only thing it can be used for is government spending. So this MMT thing, it does kind of get me a little rankled every once in a while. And it's not because I can't go on Naked Capitalism and comment for 3.5 years. It's because it's a lot of jazz, okay? It's a lot of jazz. It's a lot of jazz, and when I say jazz, I shouldn't say that because I'm a jazz fan myself, so I apologize. I apologize. And by the way, I have the wording here from Functional Finance. Functional Finance is the book that Aberlerner wrote, 1943, okay? And I have the wording here, but I'm not going to read it because I'm pretty much out of time. But this is what's going on out there in the world, folks. This is what is theoretically settling for scholarship. I really apologize there. I didn't realize that I had that narrative on the slide, and it was on the slide. But to go back to what is going on. We have the study that was done for the Icelandic government, and it's a great thing. You know, it might have limited application, but it's a great thing. Now here I was. Talks about the commercial, but this is from the executive summary. And by the way, the executive summary pretty much says it all as far as I'm concerned about it. Not that I didn't read the rest of it, I did, but the executive summary says it all. Sovereign money. Really? We're going to get that. Sovereign money system, which is what they decided to call it, okay, aims at shifting money creation from commercial banks to the state and central banks. In this report, we compare the fundamentals of sovereign money system and the current monetary system. The report shows that adoption of the sovereign money system would, well, besides transferring the deposits from being liabilities of the commercial banks, okay, I'm saying besides that, but that's actually what has to happen if the banking system is going to be able to function. Because they've got too many liabilities and not enough borrowers, and we're going to face that moment that John talked about when people are paying off more than they're taken out. It also removes the commercial banks from money creation function and separates the payment process from the bank's balance sheet. So in other words, it says it takes those banks out of both the payment system and the money creation. It gives the state the option to put new money into circulation through public finances by paying down government debt or government expenditures which would raise the disposable income and equity level of households and businesses. And if anybody doesn't realize that that's what the debate is all about right there, that is what the debate is all about right there. Gives the state the option to put new money into circulation through public finance by paying down government debt, if that's what you want to do, or government expenditures which would raise the disposable income and equity levels of households and businesses. That's what we want to do. That's the objective of having a sound, workable monetary system. And The other thing it says, does not need to affect the way the customers and the banks interact with regard to anything they do. And that's a given, but it probably does have to be stated and acknowledged. You know, when you go to the bank, what are you going to do with the bank? You're going to make a deposit? You're just going to go here or there. Okay, it's going to go here or there. And you're going to take out a loan? It's going to look exactly the same. It's not going to look any different. You're going to still have a payment schedule. It's going to still include principal and interest. And so to me, this is the next step, okay, in terms of the next thing. Because, you know, the great people that work at KPMG in Iceland were able, under their auspices of their gigantic international finance, accounting, auditing, corporate center, are able to say, this is what sovereign, you know. So we have to wait and see, of course, what happens. I'm throwing in the Mervyn King's thing. You know, it's actually older than even Dr. Weiss. A more fundamental example of reform would be to divorce the payment system from lending activities. That is, to prevent fractional reserve banking. For example, as proposed by Fisher in 36, Friedman in 60, Tobin in 87, and by more recently Kay in 2009. Of all the ways of organizing money in banking, the worst is the one we have today. You remember my talk, my little article, The Problem with Money in Banking. That was my opinion, but this is Mervyn King's, and it seems to me that we're saying the same thing. Okay, so naked capitalism. Well, you know, I'm not allowed to comment here, but I still go there every day. And I'm going to admit why. It's a great website. It is a really great website. If you're a progressive, and I consider myself a progressive, these guys are progressives. They really are. The links that they put on to depict the state of the world in terms of news of money, finance, all that stuff is better than anybody's. And I go to a lot of websites. I go to a lot of people who post daily stuff on what's going on in the world. So all my credit goes to Eve Smith and those guys. If only they got money. I'm telling you right now, if only they got money, we would really be able to do something. But they get money. They don't get money in a big way because Warren Moser, makes sure that they don't get money. I don't know if you can read this, and let me read it from up here. This was an article that was printed just very recently by J.D. Alt. It's called "The Charade That Deters the Use of Direct Spending to Fund Federal Operations." The charade that prevents the government from using public money to fund it. What is that charade? Anybody know? Debt-free money. Debt-free money. Somehow or other, we're responsible because we put out the fact that you could do it, and that has become the obstacle to them being able to do it. So I said to myself, well, let's see what J.D. Alt says. So I read through the whole article, and then I read down into the comments. And it was in the comments that I actually got some encouragement. And I hope I'm going to be able to read this. Okay, great. Okay, so that's the article. One of the first earliest comments is by Eve Smith herself. Now, she doesn't always jump in on articles, okay? It must be important. So modern monetary theory is important. She says, I hate sounding mean-spirited, but the debt-free money construct is bunk. She has 20,000 or 25,000 loyal readers every day, and that's the message that they get for today. The debt-free money construct is bunk. I don't even want you to read some of that other stuff because it's so ridiculous that it oughtn't to see the light of day. The worst, she says, about us is that we take some of the ideas from MMT, okay? And we succeed in confusing people about MMT and use its growing legitimacy, MMT's growing legitimacy, to promote our intellectually incoherent program. Okay? And then she says, I have to second Skippy on Ellen Brown, which Stephen would love to hear, but I'm not going to bring it up, okay? She means well, but she doesn't understand the Fed or money at all, and her grip on banking operation regulation isn't that good, so hot either. So that was Eve Smith's comment in there, okay? But along comes diphtherio, okay? Now, what I want to tell you about Diphtherio is way back in the day when I started commenting on naked capitalism, Diphtherio was there. And he has stayed. And he has been a loyal naked capitalism consort. But he comes in here and he says this, a few yeah buts here. Given that the debt-free money crowd has a large following, look around. I did laugh at that. I do think it's important that we make attempts at communicating in a respectful way what we think they're missing. Well, that's a great thing because that's what I wrote to Eve years ago and said, why aren't we talking about it? Okay. So it says, fortunately, they do share a number of concepts with MMT. I'd say that's the place to start. And if you read it, that's where it goes. Okay. Sorry, but then Skippy comes in. Now, Skippy is loyal. Okay. I get your point, but sadly I must report from a perspective many years in the making that debt-free sorts are akin to libertarian gold bugs, and I don't say that as an emotive slur. It's something else, okay? But I want to get to the good part, okay? It says, Eves makes a fundamental point in the whole debate, attempting to return to a quasi-gold standard. Been hearing a lot about that here, right? Okay? A quasi-gold standard with essential authority of controlling quantity of money is intellectually incoherent from both an operational and historical perspective, as well as the massive trade shock and its inevitable outcomes. You might as well attempt to stop people from having sex. Now that's what you guys are doing, okay? That's why we're here, okay? So I want to be the first of the debt-free money crowd to say, keep having sex, okay? It's all right to keep having sex. And I'm going to have to end it right there. Thank you.
Thanks so much, Joe. That's awesome. I'm sure there's lots of questions. Joe is probably the expert, or one of the experts on MMT and engaging them. So if you've got any specific questions as to how they think what they think, then Joe might be able to answer those.
Sure. Any questions? Sue?
Joe, I just want to say, having spent a year and a half in Occupy Alternative Banking, in which Eve Smith, whatever her name, was there, and watching how every step of the way she kept the concept of talking about a monetary system out of that group, that I would not recommend anyone go to her site. Because this is what happens. They plant people and they have them come on.
Yeah.
And then when it comes down, to watch people in that group for so long, just listen to lies. And she presents herself as an expert, right? But I can't, when Stephen came to try to talk, the drama she put on in that room, I'm not insane, she became dramatic, stopped any discussion, and the head of the group, who is also part of the group, said, oh, well, everyone's so upset, we can't go on. Well, then Stephen didn't get a chance to talk. It was total drama, manipulation, and she's the queen of it. So I would not suggest people, especially people who don't know the history of the money system, to go to her site. It might look good, but it's like a spider pulling people in.
Yeah. Well, I think I'm sure that you're right about that as far as the monetary discussion goes. But on the other hand, if anybody wants to try to point me in the direction of a better site that has all the links to, whether it's Hillary's email or exactly how the TPP is being advanced, to our detriment, and they do a most thorough job of that. And so, I acknowledge that, but if you want to go there don't go there for money. Don't go there for money. Oh, sorry. I'm sorry. Somebody have a microphone.
Part I don't understand is the central bankers say that they don't know what's going on, but they're the ones in the system. It's confusing to me that they keep claiming that this is a travesty, but they're the ones that actually run it. So why do they understand what they're doing? Or is it because they don't want it?
Okay, so yesterday John Howell gave in his talk, he talked about his banker friend, okay? And when the Kettle Pond Institute got started, which it got started after for 20 years, me and my Kettle Pond Men's Group, which is KPMG with small letters, okay, had our annual outing at Kettle Pond September 15th, 2008, when the crash happened. And all of a sudden, after 20 years of talking to and now everybody started with the Kettle Pond Institute. We're going to talk about debt-free money. We're going to go out and advocate for debt-free money. And then Pete laid it on me. He said, you know, my dad was the president for 15 years of a bank in Pennsylvania. Oh, really? I didn't know that. So he said, okay. Well, he said, what do you think my dad would say about what you're saying? I said, I have no idea. You know, I said, my dad says, you know, 90% of the bankers don't know how money is created, and I think that is the answer. And so Pete engaged his dad. He said, Dad, I met this guy, and he says, you know, banks just create money out of nothing. And Pete's dad said, that's not true, you know. So, and this is my suggestion to John, because I said, well, Pete, you should ask him what the accountants say about what their balance sheet looks like the day before and the next day, and the loans that were made, and what you would find is that they created the money out of nothing. In other words, they didn't lose anything. They don't take money out of their reserve account when they make loans. They just deposit it as a liability. So Pete, you know, said to his dad, well, how about that? And his dad said, no, you know, why are you listening to that guy? I won't say what else he said. But anyway, but then I said to Pete, but your cousin Patrick, doesn't he work at the Federal Reserve Bank of New York? He said, yeah. I said, well, then the question should go to him, you know. So he did. So Pete took it to Patrick. Patrick, do the banks create money when they lend? Yeah. Yeah. Well, tell Dad. So really, what I really wanted to say, and I did say this last year, and Stephen and I had a little dialogue about it. Central bankers are just as good at people as bankers are just as good at people as anybody in the world. Okay, there's no thing that afflicts central bankers with malady. So they all got involved in it for whatever reason. You know, of course, the prosperity, of course, living at the top of the heap. Yeah, but they're there to do a good job. They're there to try to make it work. Now they think, well, I'm advantaged because I'm here to make it work. But then when they come to find that, in fact, more debt is required in order to have more money, in order for us to keep this thing going, but the people don't want to borrow anymore, that's when they realize that the jig is up. And not until then, because until then, everything is going along just fine. So I believe that Dr. White is right, you know, both in his observation about how the bankers feel, and that they came by it unaware. I do believe that. They came by it unaware.
Coffee break?
Oh, sorry.
More questions for Helen?